You're listening to Booked, the bookstore education podcast brought to you by the American Booksellers Association. In this episode, we'll be tuning into Managerial Accounting, the third in a three-part financial series presented virtually in 2021.
Welcome to session 3, and I will take it from here. Start for me.
Thank you, PK. Welcome, everybody. Thanks for joining us. Just a small recap. Part 1 of our three-part series focused on, during Winter Institute, focused on budget. A budget, which is an estimate of your income and your expenses during a period of time. A budget not only holds you accountable, but it helps you track your actual and your projected expenses, as well as building on your investment. The second part series during last week, which was Bookkeeping 101, we talked about the importance of reconciling your bank account, the accuracy of maintaining an inventory, and we also said that all entries require a debit and a credit. And this can be determined in conjunction with your chart of account. We focused and defined 3 categories, which were assets, liability, owner's equity, revenue, and expense. And today we are going to talk about managerial accounting, which is our final presentation of the 3-part series. In this session, we will set up the basic building blocks for financial management by going more in depth in the key financial reports and the practical application. We will also discuss how to evaluate your income statement and compare it to the results of ABACUS benchmark study, and talk about how to improve your operations. Financial statements are the documents that summarize your financial performance over a period of time. There are 3 main financial statements. Your income statement, which is also referred to as P&L or income of operations, your balance sheet, and your cash flow statement. If you load your information into your accounting software on a regular basis, most softwares will produce these financial statements for you. You should be looking at your financial statements on a regular basis. And if you do that, you should have a sense of basic understanding of how to read them, because they will tell you how and why you're making money or not, and give you a general health of how your store is doing. Your balance sheet will outline your assets, liability, equity. Balance sheet will also show you how much your business has by breaking down what you owe and measuring it against what you own. It is the state of your business at any given point. Please focus on, PK is going to give a brief explanation of the balance sheet that should be on your printout.
Okay, there you go. Thank you, Stephanie. Okay, the balance sheet, as you see, is divided into 3 categories: assets and liabilities and equity. Now, within assets, there are current assets and other assets. What current assets mean is anything that can be liquidated into cash within a year qualifies as current assets. Things such as, well, cash is current asset, accounts receivable, your inventory, any prepaid expense or any rent that you paid in it, anything that can be converted into cash is classified as current assets. And the other assets are your property, fixtures, which also can be turned into cash, but they tend to take a little bit longer. And then the last is security deposit, which in my opinion should also be current asset, but most people have it as an other asset because it is a security deposit for any to any landlord, utility company, or anything that you do get back in case you sell or close the business. And then we go to the liability, and current liabilities work the same way. Anything that is due within 1 year is referred to as current liabilities, such as your accounts payable, your taxes payable, any line of credit payment, or anything. If you have a long-term loan, anything that's due within 1 year would come as a current liability, and everything else will go in a long-term liability. And that long-term liability is your long-term loan. And then after that is total capital, which consists of money you put in and any retained, any money that you did not take it out of the business, retained earnings. So your liabilities and capital, they should equal your assets. Okay, we'll go over the profit and loss next. Go ahead, Anna.
Profit and loss statements show you how profitable your business is performing over a certain period of time. In your business making, is your business making money, losing money, or staying stagnant? To figure out profit and loss, you should follow a simple formula. Revenue minus expenses equal profit or loss. Please remember, sales minus cost of goods sold is gross margin. And last week we said that cost of goods sold is what you pay for your inventory sold. In other words, opening inventory plus purchases equals ending inventory. Please focus on the worksheet for an explanation from PK on profit and loss statement.
Sorry, we'll quickly go over this, but later on we'll come back and I show you how to analyze these things. And that's for the purpose of this, we've compared it with ABACUS, but you can also compare with your, so if you're doing it monthly, which you should be, same month last year, if you're comparing February from last year, or your budget. There are many ways to compare this. So this profit and loss statement, first we show the revenue, and as you see, revenue is broken down into different categories: used, new books, remainders, non-book, cafe, all those categories, and then cost of sales. Now, even though there is one number here, but in the background, it's best to keep everything separate. Keep separate what you're doing on your new books and used books, remainders, so to make sure that your profits are within the industry standards, according to the industry standard. And after that is your payroll, which is then again broken down into owner's compensation, wages for salaries, benefits, any ADP costs. And once again, that should be broken down so you can compare how we're doing in individual, each category. And we'll come back and compare everything one by one. Then is occupancy costs, which is rent, CAM, utilities, and any other repairs. After that are your other expenses, including telephone, professional, office, insurance, all other expenses. That becomes your total operation expense. And your net profit, operating profit, is your expenses, revenue minus your expense. And then after that, if there is any other income which is not related to part of the operations of the store. Now, in this illustration, in cost of goods sold, I have also deducted co-op, which is, according to survey, that's what most people are doing. But once again, I do encourage that behind the scene to make sure you do keep track of it separately. Okay.
And lastly, cash flow statement, which is arguably the most important part of the most important one of the financial statement. The cash flow statement will show you where you're spending your money and what is bringing in money. Please focus on the worksheet.
Yep. Okay. Cash, we all know cash is king. I just put in this illustration how much the store have beginning cash, and then how much they made, and then anything that's not cash related, such as depreciation or anything they haven't paid for it, or anything they haven't been paid by accounts receivable. So anything that has not been paid is taken out, and that gives you a net how much you have available cash in the bank. And then anything you spend on capital expense, such as buying new computer or POS system, does not get reflect anything that has a useful life of more than 1 year, does not get reflected on your profit and loss statement, but it is a cash expense. So here you have to subtract anything you did pay and any loans that you paid as well. The principal portion does not get reflected in the profit and loss either. Interest does. That also has to be subtracted. That gives you your total cash, tells you how much you do have available to spend. All right. Well, let's go back to income statement and start figuring out how to analyze these things. So, okay. Now, as you can see, income statement, you can really see at the absolute values. If your bottom line is a plus, that means you've made money. If you look at your bottom line in this illustration, this bookstore made, average ABACUS bookstore did $38,000 in profit, while the bookstore, so there was somebody nice enough to send me their actual data. So this is an actual bookstore who has made $62,000 in their net income. Now, well, it looks good, but let's analyze it one by one and compare it. Stephanie, can we go back to the top? Now, look at this store. This store did much less than an average ABACUS store of their size, even though their revenue was $1.1 million compared to average on their size of 1.7 million, but they did much better percentage. Their gross margin was much better than the average ABACUS store. Now, which is interesting. And now you want to look at it both ways. So seems like this store did a great job on collecting every co-op that was available to them. They also did a good job in marking up their non-book and remainders, and did a good job in selecting. All of those factor into everything to the bottom line, and let's see their average is almost 5% more than the average. So these are the things you want to look at, and these are the things you do want to look at. And I'll take the questions in a second, please. And the next is total payroll cost. Looks like this is where they're also doing well. Their payroll is much less than the industry standard now. Yes, I do want to mention that I am comparing percentages, not the actual numbers. The percentage is what I'm comparing. So for example, total payroll is 18.35% for this store, as compared to payroll industry-wide is 24%. Now they have taken less salary, the owners have taken less salary, but it's comparable to the industry of 4.7%. Same thing, now their wages are less, payroll taxes are comparable. It seems like this store is not offering benefits, or is not able to offer any benefits. So it's usually works for the suburban stores where they get more students or people that want to work, get out a little bit, so they're able to do that, but it is tough to do in big cities. Now, let's go back to occupancy cost. And this is quite the opposite. This store has 20% in occupancy costs, which is very high as compared to the industry average of 10%. Now, but if you take a look at they made up their occupancy costs by having a better payroll cost. So it works out. So it's best to make your own values, compare with yourself, your budget, and what your previous history is. If you're able to do it in this occupancy, I would recommend this person to also talk to the landlord, see what they can do. And maybe, I don't know how big the store is, maybe their average sales per square foot was a little low. So if I was this store, I would focus trying to figure out how to either increase their sales or talk to the landlord about decreasing their occupancy cost. Now we go down the rest of the expenses. It seems like pretty well, they're doing well in everything except for credit card. And looks like their credit card is slightly higher than the industry standard of 2.1%. Now, all of these numbers are pre-pandemic. Everybody's credit card expenses are more this year. That's another one I would take a look and see if there's something that could be done. So it's basically trying to compare yourself. Now, in this case, I'm comparing averages. I'm comparing ABACUS, but you should be doing that every month, trying to compare your last month or last year, same month, etc. Now, in this illustration, this store has made $62,000 or 5.58% in profit as compared to an average store of 2.21%. And I see that most of that is because of how well they did with their cost of goods sold. And they probably took advantage of every promotion publisher had, took advantage of every co-op that was available to them. This is a well-run store, and that's what you should be doing. Put benchmarks for yourself, whether based on your last year or your budget, and compare every month. And if there's anything that does not look like falls within the same range, it's time to look at it and find why. And one of the reasons they've done better in net profit is their non-book sales and cafe sales are better than the average bookstore, which tend to be more profitable. So that's one of the reasons they were able to do that. So it's different for everyone else. Just to focus, see how you can improve that bottom line. All right, now we'll go to the balance sheet. Now, balance sheet is something which we should look at regular basis. This really gives you the health of the organization. It is also something your outside vendors, your lenders, banks, everybody looks at that balance sheet. It's good to check, make sure your inventory is not too high. There are several ways to measure that, and we'll come to the ratios pretty soon. Make sure that your accounts receivable are not too high. And so in this case, so let's take a look at this store. This store has average-wise 54.43% of their assets are in inventory, which is almost similar to industry standard. But if you look at their accounts receivable, it's way higher than the industry standard. So maybe this store does a lot more outside business. Each store is different. Take a look, make sure you are collecting on a timely basis. I know schools are notorious to pay late. The next thing, the property and equipment, that looks pretty well standard, and looks like in this store's case, they are a little bit matured, so they have depreciated all their assets. Stephanie, can you go down a little bit? And their total assets are pretty close to the assets of average bookstore. So once again, and we'll come back to the ratios, it seems like their inventory is higher than it as compared to their sales. And let's go look at their liabilities. Let's go down and look at their liabilities, and see their liability. Look at their accounts payable is way higher, which is not a bad thing, but it does seem like either, I know this store is not in trouble with any of the publishers, so they've done a great job in taking advantage of all the extended dating, etc., that they can. Everything else looks good. Prepaid sales in this is way higher than industry standard. Now, this data from ABACUS was done before we all started taking too many pre-orders. In this pre-sales, we have gift cards, and we also have books that we knew, front list books that we take orders in advance. They should not be recognized as sales on the date until the date of the sale. So all the pre-orders, hence there's a bigger number than usual. Long-term liability looks like they don't have any. The capital, that store capital is a little bit more invested. Looks like they've been leaving a lot of the money in the store, so their capital percentage is a lot higher than the average store. So let's look at some ratios that really tells you how this store is doing. Okay, the first ratio is, there are many ways. I could talk about it all day long, how many ways you can see if your store is doing well or not. The first thing is current ratio, which is one of the things that banks look at. Current ratio is current assets versus divided by current liabilities. In other words, all those things that you owe within 1 year, what is the ratio? Now, the banks like to look at 2%, 2 or higher. That means the company is solid. In this case, ABACUS is 1.77. This store, even though it's very well managed, but their current ratio is slightly lower than it should be. So I would think about reducing some inventory, or they have, in this case, they also have a loan they've taken, maybe paying off some loan to increase that. But once again, if you don't need to go to the bank, it's okay, it's not bad. The next ratio to look at is your current assets versus liability. Now, in most businesses, they take out the inventory, but in our case, inventory is as good as cash because most of the books you can return to publisher. So I would include inventory in there. I did not for the purpose of this illustration because that's what banks do. But in this store's case, the ABACUS average is 1.73, which is even better than what banks look at. They like 1.5 or better, more the better. And this store has 1.46. So as far as current ratio is concerned, they are doing pretty well. They have a decent working capital. What working capital is, they again, current assets minus current liabilities. And the reason they have working capital is it's a little bit deceiving because they have loan to the owner. So hopefully the owner wants to pay it back sometime soon. Yes, bank does want to see 2 or higher. Yes. The next is inventory turnover. Now, look at the ABACUS store. They are usually, inventory turnover is 5 times. In this store's case, their inventory turnover is lower. That might be okay if you're, but this store probably they should look at their inventory, refresh it, invest more in which categories were working better. This is something to be concerned about. Not majorly. Their inventory turnover is slightly low. Is something I would review and see if there's any dead stock to refresh it. Debt to equity, it's pretty good. Average is 4.79. Theirs is low. Lower the better. So they're doing pretty good in that section. There are many other ways you will find it in ABACUS report. There are many other ways to compare net sales per employee. When I say employee, that is full-time employees. Here, I don't have these numbers from our sample bookstore, but average is 129,000. Now, once again, you can compare with ABACUS, but at the same time, you can set your own benchmark. It's different for every area. So take a look at it. If the sales per employee is less than this 129,000, maybe they have too much staff, or if it is more, then maybe they do have too little staff. They can adjust it accordingly. That means having too little staff is also can be bad, meaning there are people leaving the store without being helped. So that's another not a good thing. Sales per square feet is 287. That's according to 2018 ABACUS. I'm not sure what this sample store has it. So, but that's another great way of looking at your sales net. Take out your office space, and then the net average ABACUS store has 230. Make sure you have it better than that. Other ways to look at how quickly is your asset turning over. The higher the better. This one has a slightly low, but it's not too much concern. Leverage is how much their business is leveraged. This case is 2.03%, which is pretty good. Lower the better. Average ABACUS survey is 2.03. So as you see, it is best to do this. Most accounting softwares will produce these balance sheets and income statements for you. So it is best to review them every month, compare it, and take action if needed. But more important that is also to understand your cash flow statement. Cash flow is what is very important to look at. And that is a function of accounts receivable, payable. Average in the industry accounts receivable is 282 days, which is kind of high. And that seems that's something that can be improved. Accounts receivable number of days that it takes to collect. Accounts payable. So that's basically. And if you have a budget, it tells you how well you're comparing against with your actual numbers. Budget is like a mission. This analysis tells you how well you're doing to accomplish your mission. So I'm going to open up for questions. I see a lot of them already, so I'll open up for questions.
PK, sorry. Okay, so the current assets, ratios, liabilities, there's a question about, was that what you said there was 2 or higher?
Yes, that the bank considers 2 or higher a good indication that the company is sound.
Great. When calculating sales per square foot, do you factor the entire store or just the sales floor?
So as you see, we do it 2 different ways. Selling square feet and total square feet. I don't know how that's changed now. A couple of years ago, average was 280 per selling, 280 to all the way to 554 for some of the very successful stores. Net selling per square feet was 230 all the way to 400. So yes, you should compare it both ways, but I like selling square feet. That's what counts. All the office space is really not selling for you. So selling space is probably the best measure.
I believe this next question is related to the cash flow statement. Booksellers asking where they should put co-op dollars.
So co-op dollars are already subtracted from your cost of goods sold. But once again, I encourage everybody. I used to, when I had a store, I would have it separate in the end for taxes and for closing my books. I used to take it out of cost of goods sold, but it is best to compare, keep it separate. That way you can keep track of if you have to make sure that you haven't left any co-op dollars on the table. There is a whole worksheet of every publisher is different. Some automatically give you, some give you co-ops also based on your newsletter. So different publishers have different policies. Make sure you do take advantage of that. And looks like in this sample store has done a great job in collecting all their co-ops they were entitled to, but it is factored into cost of goods sold.
Okay. In the previous session, you mentioned that we should track front list and back list buying separately. Would front list be considered accounts receivable until the books are received from the publisher?
No. Accounts receivable. So the front list, there's a separate buying budget. This cash flow really tells you how much you have available to spend. So in this illustration, for example, this store has $34,000 at the end of, let me just take a look. So in this illustration, I went through and reconciled how we came up with the cash that you had in the bank. So in this case, store had $34,238 in the bank. Now, that does not reflect any future buying. For that, what you have to do is cash flow forecasting, which we had it in our budget session. And I also have worksheets available that I will send it. If anybody wants it, feel free to email me. I think we may even have it, Lisa, we have it on the book web, right? The cash flow worksheet that we did.
Mm-hmm.
Yeah, okay, well, I'll make sure of that. So that is a separate worksheet. This tells you how much you have to spend. Now from here, what you have to do is you have to take a look at, so if you're doing it for 3 months, see how much your sales are going to be cash sales. When I say add all the cash sales you will have, subtract anything yet you think will be receivable, add any previous receivable, and then you figure out how much you have left for buying next 3 months. And then when you sit down with your rep, you can take a look at your historical data, and I think it's basically depends on each store. Take a look at it, whether it's 60-40 or 50-50, how much you're buying in your front list, and plan accordingly. So if you think your backlist buying is 50%, then you know whatever the number that is, you're left with the other half is available for front list buying. So when you're sitting down with your rep, you know you have a budget in mind. And then I would take that number and spread it into different publishers based on, like for example, Penguin Random House is your biggest publisher. So if you have 30,000 to spend and they are 40% of your business, I would allocate 40% to them, and so on and so forth. So it is a separate worksheet. I can send it to you. But in this one, it does not take care of it doesn't show anywhere what your buying should be.
A bookseller is asking about the pros and cons of fully online bookkeepers. If we have do you have any thoughts?
I'm curious about that question. We use QuickBook and we do our own entry, but I'm curious of how do you totally online? How do you submit your information for, do they make your entries for you? How does it work? The question is from Lacey Simmons. I'm just curious of how you.
Yeah, we've only started using it for like fiscal year 2020, partly because we had so many problems with QuickBooks Online, which our former accountant, demanded that we use. And so they haven't been doing any of our bookkeeping yet, but of course it's like an add-on service that they provide. And I'm just starting to, explore that possibility. So, so I'm basically asking everyone who will let me ask them.
So Lacey, when you say online accounting, do you mean having your information stored in the cloud?
No, well, I just, it's fundamentally the same as QuickBooks Online. It's just not a dominant program in the way that QuickBooks is. They don't have as much, they don't have as many accountants locally who use it. It's not the kind of industry standard. And because it's a platform that may be geared more for people who have like Etsy shops or do cash-based accounting, I wondered about if I had wandered into something that might bite me later, but I've just had bad experiences with local bookkeepers. So the online question is mostly like this, if we use a bookkeeper with them, it's not going to be someone we ever see. It's going to be someone who lives in Chicago and doesn't know our business very well.
Yeah.
PK, she's talking about the Wave online software, which I've used it for my coaching business. So I think the only concern is that it is more cash instead of accrual based, and it might not have all the inventory features that QuickBooks Online would have regarding cost of goods sold and some things like that. I think one of the advantages of the online is how many things it will integrate with. So if I were doing something online, I currently use QuickBooks Desktop, but if I were doing something online, to me, the main advantage would be the number of integrations. So I would probably go with the one that integrates with my banks and my credit cards and stuff to pull everything in automatically with me.
Yes, I've also used Desktop, but I use Sage. So I'm sorry, I don't have any experience with online other than that.
Do they pull the information for you, or you have to manually put the information in the system?
Oh no, it integrates with my bank. So yeah, if it was manual, then I would have, I don't know, I would have flown to Bali by now just to hide out from that task.
Well, there are a lot of developments in that. Pretty soon, I know a lot of POSs are talking about directly downloading the invoices to your accounting software, which to me would be the best way to go, because bank is basically, that's just what Jill just said. It is for cash. The software will not know until you've paid that vendor. So it's mostly for businesses that don't have inventory. So yeah, I don't know which POS system you're using, but that's something to keep an eye on. Go ahead.
Okay, there's a conversation about co-op dollars and ABACUS. And is it the best place to put co-op dollars as, is the best practice to place co-op dollars as cost of goods, or is it to offset marketing expenses?
My opinion, the best place is to offset marketing expenses, because that's where it belongs. But I was outnumbered. Most people had it through their co-op. And the reason, and another reason could be, is when you get co-op, you get a credit memo from a vendor. And a lot of bookkeepers are not even used to recognizing, oh, this is different than your purchases or your return credit. So they just tend to enter everything in purchases. But I do agree. It is the best one is to take it out of your marketing, or even put it as a separate income line on the profit and loss statement. But I just went with that because of what most people were doing.
We are at the end of our questions so far in the chat. I know you have questions that came in, PK and Anna. Do you want to answer those?
Sure.
What is the difference between bottom line and net profit?
Great question. So net profit is profit before income tax. Now, so if you make, and that is also different for everybody else's and how they're structured. For a C corporation, you get taxed based on a corporate tax, but if you're a S corp or LLC, you get taxed on your personal income tax. So the bottom line is what you made after paying your income tax. Net profit is before taxes.
This question, I think we already answered it. It says which is the, if you only had to choose from one of the statement, which one will you choose? And I think we said the cash flow statement because it gives you an idea of how the company is doing, how much cash is generating. But you should also keep in mind that all three of them are important to get a full picture of how the store is doing.
I would also take a look at the couple of things. I would also take a look at it. One of them is sales per square feet, which is, it's a pretty good number to compare, to make sure you keep striving towards higher and higher number. That's one number I would regularly look at. Gross margin, sales per employee is another good numbers to look at. So yes, even though cash flow statement is something you should always be reviewing and then basing your future purchasing based on that, but still there's always look at your inventory turnover number, sales per square feet, and things. Those couple of things I think should be looking at every month and comparing it from previous year or your budget.
Which is the most important ratio for bookstore owners to stay on top of?
That's the one. Sales per square feet, and employee sales per employee, which means making sure that you're not over inventoried. You're not spending too much. You don't have people that just are not needed. Make sure you take a look at your payroll and take a look at your graph, see what your busy time, more people when you're busy, less people when you're not busy. So sales per employee, and make your own benchmark based on your previous history and stick with that. Now in this sample bookstore, they're doing a lot of things right. They are making more money than the average bookstore. So if this is what their payroll is, then they're doing a great job. So make your own benchmarks.
Sorry, PK, I didn't mean to cut you off. We do have two questions from the audience, the live audience. Jill Hendricks, did you want to unmute yourself and ask your question?
Yeah, so I guess I'm a little bit of a rebel here, PK. I understand the theory about all of this, but I find that practically it's just too complicated for a business my size. I understand a publicly traded company with accountants and bookkeepers, and they're going to put together these statements for people to look at. But do you have any practical advice about how to actually do this in a real life small company that, you have so many other priorities? Just the cash flow statement does not automatically get generated out of my QuickBooks. It's a lot of, adding this in and subtracting that and predicting this and, guessing on that. And then none of the guesses come to fruition, and then you're doing a lot of adjusting. It just doesn't seem worth the benefit to me.
Do you feel like you run out of cash, or do you have times where you say, oh man, how am I going to do something like this?
Well, I did, but I couldn't use your system. I had to find a different system that worked better for me. So now I use Profit First.
Oh, okay. Well, that works. I mean, if that works for you. So how does that do?
That's where you don't try to predict. Instead of it's a system of once your cash comes in, how do you allocate it?
Okay.
And then you have these different buckets. It's very clear how much you have to spend. So I don't do a lot of the prediction part. It's more, I just deal with what I ended up with.
So, but you do it after?
Yeah, so my money comes in each week to one bank account, my income account. So that's where I put my cash deposits. That's where the credit card goes. That all goes into one bank account. And then every week I take it and I divvy it up. So I have an inventory account, I have an operations account, I have an owner's comp account, and then expenses just get paid out of that.
So that's basically what you're doing. You're kind of doing your own forecasting.
Well, I don't forecast. It's more, I just deal with the reality of the money I have.
So what happens? Do you have money left over at the end? Or, I mean, you're lucky, then your store is doing great. There are some people who have to make a choice between buying front list book or paying rent this month. So, I mean, are you able to, if it is working?
What I've done is I've made some priorities. So I decided that my operating expense was my first priority. So that's rent and employee payroll, all that stuff that keeps everything running. So I fill that bucket first of I've combined the operating and the inventory together. So all the money that comes in first goes to operating expense. And then if I have any money left over, it goes to paying inventory bills. If I don't have enough money to pay the bills with the publisher, then I have to pull a bunch of returns, or I have to stop buying so much books, so that part kind of self-corrects.
Yeah.
So you're doing a mental budgeting in real time, but you're just not writing it down, sort of speak, but it is a mental
to
budgeting.
Me it's kind of budgeting after the fact. I don't plan my buying as much. It's just if I bought too much, then I have to do returns, or I have to call the credit rep and explain that I made a mistake. I do not have the cash to pay you this month. What are we going to do? So the pain of going through that with the credit rep helps me improve my buying in a way that predicting and failing in my predictions just wasn't working for me.
Yeah, I mean, you're in fact, you're doing the same thing. You are predicting how much you have left over, or how much you have to cover with inventory, which is fine. And the other thing I would recommend is get a line of credit as well. So it seems like in the end, if everything works out for you, get a line of credit too. If say, your prediction didn't, you ran out of money and you don't have enough money to pay the landlord this month. Well, go ahead and use that line of credit. Remember that you have to pay next month. That means you have this much to return. You have to do this much in return, or see where their sales went wrong. I have done that. So that's called, mental budgeting, what Anna just said. But you are in fact doing that. I find that works too, but it is a little, stressful that you have to make sure that afterwards, make sure that there's money left over. So that's why we like to say, plan ahead. And I know it is hard for businesses to do, but if you just do sales per square feet, inventory turnover, few things that we could just quickly look at your balance, financial statements and look at every month and compare it. And if there's something goes wrong, then just you can focus on those things.
Well, speaking of that, PK, do you recommend then that everybody calculate cost of goods sold monthly? Most stores that I know do it yearly.
Well, you do your POS gives you a number every month, what is left at the end of the month. Now, you do have to make sure all the invoices are in, make sure you've gotten credit for all the returns. If you haven't, you can add and subtract that. But yeah, you get that number. You don't have to physically count your inventory every month, but you can use that number from your point of sale system to calculate monthly cost of sales. Easy to do. All cash, well, I shouldn't say all, most POS systems do that. They give you a number at the end, how much is your inventory. Now, is it always correct? No, but it is pretty close. Now, I from my store, it was the percentage from actual inventory to this, what my computer said, it wasn't a big difference. It didn't make a huge difference on the bottom line. So the POS, if you're receiving and returning properly, it's pretty close. Yes. There are more questions on there? I see a lot of chat.
Yeah. It looks like not really. Let's some great conversation. We have 6 minutes left.
Okay, Anna had some more questions.
I did. I'm just going through the chat because I think there were some stuff that we missed. In the meantime, someone is asking, give some example of prepaid expenses and accrued expenses.
So prepaid expenses is, let's say you have to pay for your insurance in advance. That would be a prepaid expense. Or you have a special product that I know in my cafe, they always used to ask me for money in advance before they would send my shipment. Well, from the time I send the money to the time actual products came in, it's a prepaid expense. What else can I think of? Anna, can you think of other examples that we have in
Prepaid expenses? Mostly marketing. If you're doing any type of advertisement or marketing for any future period.
Yeah, that's a prepaid expense. Rent is another one most people have to pay beginning of the month for the whole month. So for that month, it's a prepaid expense. Accrued expenses are, say if you bought something, you had a repair done and the contractor hasn't sent you an invoice yet. So that's, the expense is coming. So that is an accrued expense. Or you bought inventory now until the time you get the bill. Now, if you bought inventory it showed up on the last day of the month, you may not get invoiced right away. So you could take an estimate and say, well, that's how much we know to accurately see how much profit you made. You estimate that and put it in as an accrued expense till you get the invoice, and then it goes to accounts payable.
Thank you, PK and Anna. I think we are at time. So I just want to thank everybody again for participating in the conversation and coming to the session. If you have further questions on this, you can email pk@bookweb.org. Specific ABACUS questions, I know Dan Cullen, Dan at bookweb.org is very involved in that, and he can take your questions on ABACUS. And I'm sure Anna as well, Anna at bookweb.org, it's ANA, can participate in question and answer on this topic. So thank you all again very much.
And by the way, we'll be opening up ABACUS for 2019 and 2020 in April. So please participate. That there are a whole list of ways you can gives you a whole list of ways you can analyze your business, and you don't have to do them all, but you could pick and choose. At least make good business decisions. Thank you.
I see one more question from Gavin. This is the final session in our financial series on this session, but we will have future financial education. Okay, thank you all.
Thank you.
Thank you.
Thank you for listening to the Bookstore Education Podcast, brought to you by the American Booksellers Association. Don't forget to subscribe to the show on your favorite podcast app. Additional educational resources can always be found on the ABA website at www.bookweb.org. Happy reading!